Thanks for clicking! Canada's mortgage borrowers are continuing to pile into variable rates despite mounting inflation risks. This according to Rob McClister of the Financial Post. Yeah, Rob McClister, of all people, is continuing to warn of the potential downsides of taking on a variable rate mortgage, noting that if inflationary pressures start to ramp up higher, rates will have to rebound.
That'll never happen.
And while I generally don't take anything from the mortgage industry overly seriously, when this kind of warning comes from Rob, who's afraid of the big bad variable McClister, it might be worth taking a closer look. Only Nixon could go to China and whatnot. Yet, while according to McClister, risks surrounding variable rates are starting to mount, unlike the pandemic and soon thereafter, this time around there's also risks with taking a fixed rate as well, especially in a declining interest rate environment. So what I want to do today is go over McClister's article, taking a look at the choice between variable and fixed in 2025, and then go over some of the unique risks to the current policy environment. Mainly, don't get charged a $30,000 mortgage penalty. As we'll see today, this is obviously a massively uncertain time when choosing a variable or fixed rate mortgage. We will obviously continue to track how this all plays out on this channel. Make sure you click like and subscribe if you want to get those updates, but for now, let's get into variable rates. On to the article. As mentioned, broker idol himself, Rob McClister, is warning that with variable rate usage skyrocketing, we should all be aware of rising inflation expectations. And make no mistake, variable rate usage is indeed increasing, with uninsured usage up over 30% as of December. In insured mortgages, those mortgages with less than 20% down, that usage is increasing up 16% as of December as well. As such, with interest rates on their way down, more people are trying to take advantage of variable rates. Nowhere near the insured usage that we saw during the pandemic, but definitely rising. Now, just a quick word of warning for first-time homebuyers specifically, as I know for a fact that the usual suspects are starting to beat the drum for variable rate mortgages.
Have I ever steered you wrong? Always.
When the people recommending you these things say, well, over the long term, variable rates perform better than that of fixed, they're citing this academic paper written by Moshe Milevsky, which I can guarantee you almost 100% they have not read.
I'm not doing too much. I am not doing too much.
That paper, which has been called Canada's most misconstrued mortgage study, says specifically that floating rate mortgages aren't really meant for first-time homebuyers, as they don't have a lot of equity in their home. Meaning, say, if you buy at the benchmark price of $720,500 with minimum down payment plus mortgage insurance on that first month of ownership, you owe almost what the home is worth the minute you take possession. So if prices drop and rates rise, which, as we'll see, isn't out of the realm of possibility in the current environment, you could find yourself in a spot where you owe more on the home than it's actually worth.
That's not possible.
Yeah, and if you want to test your usual suspect and whether or not they've actually read the thing they're citing, ask them about the methodological problems associated with Shelley Shore and Linda Long. If that suspect doesn't mention that that study doesn't actually analyze a true floating rate, rather assuming that prime is fixed on a yearly basis, then they didn't actually read it, as that's a big, glaring methodological problem. Though that's not at all to blame the author, I'm assuming that was due to a lack of data, a common problem across time studies. Regardless, the move into variable rates for those who can afford it does actually make sense at this point, as the economy is worsening on uncertainty from the United States. And if this continues, the Bank of Canada will indeed be cutting, with even the governor noting at the previous conference that the bank thinks its current rate is neutral, meaning it would have to cut interest rates in order to stimulate.
The governing council thinks of us as, in that neutral range.
So variable rate usage is increasing, and all hints from the Bank of Canada show that we could be in for more interest rate cuts as this goes on. But, says Rob McClister, this could in fact become a problem, as rising inflation expectations could combine with escalating tariffs, and combine that with a weak Canadian dollar, combined with supply disruptions, that could fan the flames of inflation. And if that happens, if inflation does take hold, says McClister, and as we'll see, basic economic history, the Bank of Canada will raise interest rates, recession or not. And we've talked about this before on this channel. The bank will always 100% of the time save the currency rather than the economy. We saw this back in the 1980s when unemployment was at 7.4 and inflation was at 12, and the bank was just about to raise rates, which sent unemployment shooting up thereafter. And obviously, if you're not in real estate or mortgages, you understand the risks inherent in variable rate mortgages, in that if inflation starts to take hold, the Bank of Canada will 100% of the time raise interest rates. as a means of saving the currency rather than the economy. No need to belabor the point, it's pretty straightforward.
I don't get it.
So, more and more Canadians are moving into variable rate mortgages with very good reason. As with this uncertainty continuing to come out of the United States, it does look like rates are going to continue to come down. But, and I can't stress this enough, a variable rate in a time of uncertainty is not a set it and forget it type of rate. You need to keep an eye on A, the bond market, B, the money supply, and C, underlying inflation. You need to do this yourself, as 100% your bank, your broker, your realtor, the ones that recommended it, will not do it for you.
That we know.
So, those are the worries if inflation does in fact take hold. But what if it doesn't? What if the fallout from these tariffs are so great that it keeps inflation kept in check, which the bank is already warning of this possibility?
Uncertainty that weighs on household and business spending tends to put downward pressure on inflation. And new tariffs will hurt our exports and weaken business investment.
Yeah, and under this prospect of a severely weakened economy and a prolonged recovery, buyers, and especially those renewing, should really think about what kind of rate they are taking. Under the scenario where the economy weakens so much that we continue to see interest rate cuts coming from the central bank, that could create a problem for those who decide to go with fixed rates. Let's say you don't like the risks inherent in a variable rate mortgage, so you go with a 5-year fixed rate from, say TD Bank for 3.71%. And then, due to circumstances outside your control, you lose your job and have to sell your home. That's exactly what happened to a homeowner back in 2020, when said homeowner had to sell her home as her income as a real estate agent dried up. She had to sell her home and was charged a $30,000 penalty by TD for breaking her mortgage. And as to why the penalty was so high, without going into the math too much, suffice to say that if that homeowner was paying 3.7%, broke the mortgage, paying back the mortgage company, paying back TD, which back in 2020 could then only lend that money out at 1.5–2%. The difference between those two rates, TD sees that as them losing money.
I am never going to financially recover from this.
And remember, that hefty penalty was during the pandemic, a time under which Rob McClister noted that ideally banks would have showed some compassion. But of course they didn't show any compassion back in 2020 because they're banks. And this time around, if you do have to sell your home through no fault of your own due to the fallout from this trade war, but if you do have to sell your home, the banks aren't going to show you compassion this time either. If you're paying a 5-year fixed at 4% and the bank can only lend that money out at 3%, they're going to charge you a great big penalty, especially if you still have 4 years left on that term. So, in summary, variable rate usage heading down, variable rates set to get better as the bank does cut rates short term, though inflation worries continue to abound. In contrast, fixed rate mortgages also coming down do give you a little bit of safety, but if you do have to break that mortgage, you could be at risk of having a great big penalty charged against you.
You're getting one way or the other.
So, at this point, definitely not that great of time, depending on who you are, to be in the mortgage market, which I think is definitely showing up in the home sales data. Best thing that anyone can do is take a look at their budget. Can you handle the swings of a variable rate mortgage? And are you willing to continue to look after the fundamentals? Continue to check the bond market, the underlying inflation rate, and money supply indicators.
Not my job description.
On the other hand, if you are in one of those industries that are at risk of a job loss, manufacturing, auto sector, etc., then a 5-year fixed may not be the best route to go. If you are at risk of losing your home, if you do lose that underlying income, especially for a prolonged period of time, then maybe something shorter term might be the best option. Not necessarily a variable where the penalty is only 3 months interest, but a shorter term so that the penalty won't be as big if things don't go the right way. With all that said, we will obviously continue to track how all of this plays out on this channel. Make sure you click like and subscribe if you want to get those updates, but for now, thanks so much for watching.